options, remember. In the long call also break even is strike price plus premium. In the short call also the break even is strike price plus premium. Remember, long or short is your decision. Whereas strike price plus premium is the inherent characteristics of a call option. Correct. This is how the graph looks like. As the stock drops, you will have limited reward up to the amount of premium that you have paid, and if the stock goes against you, you're going to have unlimited losses, and that is going to be your break even, strike price plus premium. Now in the long put option above supply, this was the plus P, right? In section 1, you're going to be a buyer of a put option. In section 5, instead of buying a put option, you will sell the put call option. So trade action is sell an out of the money call option, because when you're selling options, you have to only sell out of the money options because they only contain time value, which is a wasting asset. Again, parameters 60 days or less, and minimum minus 0.25 delta. Why is the delta minus 0.25? Because it's a bearish trade. Absolutely correct. And strike selection is at the money or above the distal line of the supply zone being used. Again, close if the target is met, or target or stop is met. Close if the short unit, that is the minus C, is trading for 10% of the premium received. And evolve if implied volatility shifts from section 5 to section 4. Aren't the rules simple enough? That's it. So here you had bought a 5900 put because volatility was in section 1. Now we are selling the call in section, because it is in section 5, you are selling the put option, call option. Delta is delta less than or equal to 0.25? Sorry, greater than or equal to minus 0.25. And theta and vega, whatever you get, look at the value of theta. So every single day passing is going to reduce your theta by 2.5, reduce your premium by 2.5 rupees. And every rupee fall in the stock will add 50 paise. And if volatility drops along with that, this is going to add 6, this is going to shave off 6.5 rupees. So if the stock moves in your favor, 50 paise is going to get reduced. Along with that, if one day passes, 2.5 is going to get reduced. And along with that, 1% of implied volatility falls, you're going to lose another 6.5. So 6.5 plus 2.5 is 9.5 rupees of 90 rupees. Approximately, if all the parameters work in your favor, with in a day you will lose 10% of the premium. Is that clear, everyone? So we have completed short call, short put, long call, long put. Unlimited. Why is risk unlimited here? अरे सुशीला, इतना नेगेटिव नहीं सोचने का. ढूंढने से तो भगवान भी मिलता है. And good things always take time. Remember, good things never happen in a hurry. Because you have sold options and you have collected premium, the reward is limited to the amount of premium that you have received, and the risk is unlimited. Correct. Break even, since it's a call option, break even is strike price plus premium. And it is irrespective whether you are selling or buying options. Remember, in the long call also, break even is strike price plus premium. In the short call also, the break even is strike price plus premium. Remember, long or short is your decision. Whereas strike price plus premium is the inherent characteristics of a call option. Correct. This is how the graph looks like. As the stock drops, you will have limited reward up to the amount of premium that you have paid, and if the stock goes against you, you're going to have unlimited losses, and that is going to be a break even, strike price plus premium. Now in the long put option above supply, this was the plus P, right? In section 1, you're going to be a buyer of a put option. In section 5, instead of buying a put option, you will sell the put call option. So trade action is sell an out of the money call option, because when you're selling options, you have to only sell out of the money options because they only contain time value, which is a wasting asset. Again, parameters 60 days or less, and minimum minus 0.25 delta. Why is the delta minus 0.25? Because it's a bearish trade. Absolutely correct. And strike selection is at the money or above the distal line of the supply zone being used. Again, close if the target is met, or target or stop is met. Close if the short unit, that is the minus C, is trading for 10% of the premium received. And evolve if implied volatility shifts from section 5 to section 4. Aren't the rules simple enough? That's it. So here you had bought a 5900 put because volatility was in section 1. Now we are selling the call in section, because it is in section 5, you are selling the put option, call option. Delta, is delta less than or equal to 0.25? Sorry, greater than or equal to minus 0.25. And theta and vega, whatever you get, look at the value of theta. So every single day passing is going to reduce your theta by 2.5, reduce your premium by 2.5 rupees. And every rupee fall in the stock will add 50 paise. And if volatility drops along with that, this is going to add 6, this is going to shave off 6.5 rupees. So if the stock moves in your favor, 50 paise is going to get reduced. Along with that, if one day passes, 2.5 is going to get reduced. And along with that, 1% of implied volatility falls, you're going to lose another 6.5. So 6.5 plus 2.5 is 9.5 rupees of 90 rupees. Approximately, if all the parameters work in your favor, with in a day you will lose 10% of the premium. that clear, everyone? So we have completed short call, short put, long call, long put. How rapidly volatility drops? So volatility will drop sharply. Yeah, if everything works in your favor, Rahul. So volatility can drop in one day from section 5 to section 1. But that will happen only when the news event is out. So should we take a quick 10 minutes break and then come back and do section 2 and section 4 strategies? Alright. So see you in 10 minutes. to drive the profitability trade, and that an hour, and then I will probably all right. Welcome back, everyone. Can you please confirm if you can hear my voice and see my screen? All right. So Nifty, as I said, Nifty is going to be around 10,800. So this is where it is probably going to expire, the weekly expiry. Okay, let's go ahead with multi-leg strategies. Okay, so we covered four strategies: long call, long put, short call, short put. They are pretty straightforward. If you have understood them right, one and two, the vertical debit spread and the credit spread will be very, very simple. Okay, remember, so guys, we are running behind the schedule. I don't want you to ask me any questions other than what is being taught to you. Okay, so I need to complete these four strategies in the next half an hour, and then I will probably revise it again tomorrow morning. So it looks difficult that you're going to get time for practice. So you have to practice at home later on. I'll give you exercises. You can do those. And anyways, XLTs are there to take care of your practice. When using single leg strategies, we are using only one unit that is responsible to drive the profitability trade, and that is what we call as the anchor trade. Now we will learn that when using multiple strategies, multiple leg strategies, we will still use the same anchor unit. So if section 1 strategy was 100 call option, buy 100 call option, in section 2 also we will still use 100 call option. If the demand zone is the same, we will still use 100 call option as our anchor, but at the same time we'll add an offset unit to custom tailor the Greek characteristics of the resulting position. Okay, so what happens is when volatility moves to section 2, has your option acquired some bad properties? And what is that bad property here in section 2? The IV, the implied volatility has changed, because of which Vega has also risen. But the disadvantage is, as if the volatility drops, you bought something that was expensive and is going to reduce in value, thereby giving you a bigger loss. Okay, now to mitigate this risk of volatility dropping down and eating into your premium, we have to add an offset unit. कुछ नहीं, अंगूठी है ऑफसेट यूनिट, मतलब अपने हाथ की अंगूठी, ये इसके लिए, ये उसके लिए, ये हो जाए करके, ये वो हो जाए करके, मैनेज करने के लिए, बस वही है. बेसिकली एंकर यूनिट में कुछ दोष है, उस दोष को बोलते हैं ना, लड़का बिगड़ गया शादी करा दो उसके, सुधर जाएगा. वैसे ऑफसेट यूनिट के साथ शादी करा दो एंकर की, ठीक हो जाएगा, तकलीफ नहीं होगी. दोनों साथ में रहेंगे तो कुछ नहीं होगा, जिम्मेदारी आ जाएगी, कुछ नहीं होगा. Offset unit, a second unit using unit using a multi-leg strategy that is bought or sold against the anchor unit, which means if your anchor is a buy unit, your offset will be a sell unit. If your anchor is a sell unit, your offset is going to be a buy unit. Clear? Yeah, it has to be the opposite trade. So if your anchor is a buy, no, not put, not put. Sorry, Chandrasekhar. I did not tell you what call or put. Do not preempt and do not try to assume things. Just pay attention. It's not like a stop loss. It is only used to mitigate the bad properties of the Greeks. The bad Greek properties of the anchor unit. Since it has acquired bad properties, we need to mitigate those risks. All right. Now, can we? So let's say you bought 100 call option in section 2. Now it has a Vega value which is higher, but it can go against you also. So how do you change this bad property? Can you drag down people's expectation into section 1 because my stock is coming into demand zone? Hey, ज़्यादा मत सोचो, नीचे आ जाओ, section 1 में लेके आओ. अब it is not in our hand, right? So the only thing that you can do is manage the bad characteristics of the anchor unit, and the only way you can manage is by adding an offset unit. Okay, so we cannot alter the Greeks of an anchor unit. Therefore, if it provides too much or too little vega or theta, okay, too little vega or theta, depending on the market conditions, we buy or sell an offset unit against the anchor unit. So if your anchor is a buy, offset will be a sell. If the anchor is sell, your offset will be buy. Offset units are used to keep vega under control. So primarily offset units will manage vega values. Okay, all the other Greeks will be impacted too, but the one that produces the greatest concern is vega, since volatility can quickly move to unreasonable extremes. Volatility can move to unreasonable extremes. All right. When using offset unit against anchor units, the net Greek effect is simply the sum of individual Greeks. So if let's say you bought a call option and as an offset you sold another strike call option. So both of them will have their Greek characteristics. So you just simply have to add for the resultant position. So the resultant position will be together, not individual legs. So now let's take a look here. The first one is anchor. This is the Apple stock. You're selling one lot of 555 put option. Okay, one lot of 555 put option for a whatever value is 18 rupees. And look at the value of delta. Now this is the value of delta. Is delta greater than, so 44.52 is nothing but 0.4452. So is it greater than 0.25? Now look at theta. 32.5. Now 32.5, is theta really good for us? Because this is a short put trade. So higher value of theta is beneficial for us, right? Yeah, but look at the volatility impact. The Vega impact is 65 nearly. And that's really very high. Because what if the volatility drops 1%? You're going to shave off 64 from your premium. Now, how do we manage this? So since my anchor is a short put, I am going to add an offset which is going to be long put. but different strike. Same expiry, but different strike. So 555 long put December expiry. Since that had bad Greek characteristics, I add a 515 put option. I buy this 515 put option for the same expiry, and it will have its own. So it is going to cost me because I'm going to buy that. So 18 is what I received, isn't it? 18 rupees is what I received by selling the put option, and out of that 5 rupees 80 paise is what I give back for my protection, for mitigating the risks associated with this trade. So my net credit is going to be 18.050. This 18.050 minus 5.820. That's going to be my net credit. And now, so this offset unit will have its own Greek. So it has a delta of minus 18.61. It has a theta of minus 23.66, and it has a vega of 43.83. Now you simply do the math here. 44.15 minus 18.61 is 25.91. Do we have minimum 0.25 delta still? What, no, Arun? What is this? 25.91. It is, right? We need a minimum 0.25 delta. Now theta has reduced. That's a drawback, isn't it, for our trade? Because we are in a credit trade. Since your anchor is a short unit, it's a credit trade. So theta has been compromised here, correct? But look at the vega. Has vega drastically dropped? So which means now 1% drop is going to, you're going to lose only 20 instead of 65 or 21. Now tell me one thing, theta has reduced, but is that really a concern for us? Why? Why it's not a concern, Sushila? The reason we don't have the concern is, you know that as time will pass, theta will keep on increasing, right? See, the theta initially was 33. Because of our offset unit, it dropped down to 9 rupees. So we, in credit strategy, we need higher values of theta, right? But here, because of the offset unit, theta is getting compromised. But we are really not worried about that. Why? Because we know eventually as time passes, theta will keep on increasing. So our focus was on to manage vega. Okay. Similarly, now you take this, the lower one is a debit strategy. Here the anchor is a long call. Okay, the anchor is 555 call option which you're buying. Now if you see here, this has a good delta of 55.56, but the theta value is now higher, and the vega value is higher, but we are okay with higher vega value because we are buying options, isn't it? Yeah. So we then add, so since the anchor is a buy, we sell the offset. We sell the offset, 620 call option. So it's a net debit still. Why? Because 41 is the debit for anchor, 16 is the credit now for offset. So your net debit is 41 minus 16, that is 25 rupees. Now once you do the math of these Greeks, is delta above 0.25? That's a minimum criteria that we have. Now has theta drastically reduced? Have we managed theta very well? And we have also managed vega, because if vega was going to volatility drop down, you're going to lose higher amount of premium. That also has got tamed now. So in debit, though increase in volatility is beneficial for a debit strategy, Here we will add lesser amount for increase in implied volatility, but we will ensure that our time decay does not hurt us. As well as any drop in implied volatility will not shave off a lot of my premium. Okay, that is how we keep the directional bias. Correct, Amit. That is how we keep the directional bias of the trade. The reason why we got in, as we reduce the unwanted Greek characteristics of the anchor unit. This is accomplished by selling a unit against the one that is being bought or buying a unit against the one that is being sold. The net resulting Greeks are simply a sum of each individual Greeks. So what are the characteristics of multi-leg strategies? More than one unit is bought or sold at the same time. Buying units of a higher rupee amount, that is the anchor, and selling units of a lower rupee amount, that is the offset, at the same time would generate a debit. Selling units of a higher rupee amount and buying units of a lower rupee amount at the same time would generate a credit. Depending on the type of units being used, calls or put strategy would become bearish or bullish. A common name for multi-leg strategies is spreads. अरे बताऊंगा आगे जाके बताऊंगा अमित, होल्ड करो. Now spread strategies are the best strategies. Most of the option traders in the world are, they trade spread strategies. Because it is limited risk and limited reward. Alright, Bhavya, any questions? I'll come to that, Ramesh, hold on. तुमको बाउंसर डालना मुश्किल है, मैंने पहले ही बताया था. So when volatility shifts from when the stock is hitting your demand zone and volatility is in section 2, you really cannot be a buyer of an option. Why? Because if volatility drops, your premium is going to reduce and that is going to hurt your position. Now to protect yourself against this, what you do is you add an offset unit. So if your anchor is a buy call, your offset will be a sell call different strike. And if your anchor is a sell put, your offset will be a buy put. You're selling the offset unit, so that's why just hold on, right? You will come to know when I give you examples. Let's begin with the first vertical debit spreads. These are done in volatility section 2. Only section 2. You will not do this in section 1. You will only do this in section 2. Yeah, implied volatility is in section 2, Bhavya, not 1. Okay. So the bullish strategy is called as a bull call spread and the bearish strategy is called as the bear put spread. Bearish using a put spread, bullish using a call spread. This is the example. All right. Scrip is in an uptrend and trading in a demand zone. Implied volatility is now in section 2. But so what is the benefit here? We have potential benefit from implied volatility reverting to the mean. So that benefit of the IV is if it moves from section 2 to section 3, it's going to be beneficial. But what if it moves from section 2 to section 1? Can that happen? Yes. So to protect your position, so when the volatility drops, will it reduce the premium or increase the premium? It will reduce the premium, right? So let's say you bought a premium in section 2 for 20 rupees, and the stock is still trading in the demand zone, but volatility dropped. So it will probably shave off. Without the stock even moving, you would have lost 4 rupees in your premium. Alright. So to protect ourselves from this, we use an offset unit. The offset unit provides protection in case IV does not revert to the mean, that in case the IV doesn't go up but starts dropping down. Yeah, this will happen quite a lot of times. Okay. This is how the graph looks for a bull call. For actually a long call, how is the graph? This and this, right? This part is not there. This part is not there. So it will be unlimited risk because you unlimited reward, because you added an offset. The reward becomes limited. Risk limited, reward limited. Break even is anchor, strike plus premium. Because the anchor is a call option, the break even is going to be anchor plus premium. Delta is positive because we are in a bullish strategy. Theta is negative because we are in a net debit strategy, and Vega is positive. Now Vega is slightly positive, not heavily positive, because we have added an offset unit which has reduced. Now this delta, theta, Vega is not for the individual Greeks, okay, individual strikes. The delta, theta, Vega is for the combined position of a plus call and a minus call. Nizamuddin and Bhavya are typing. Do you have any questions? Oh, because it showed that you're typing. You'll come to know in the next slides, Rameshji. So let me finish the entire strategy. Then you ask me your questions. What happens is when I'm asking, most of you are asking me questions. That is going to break the flow. So let me finish. All your questions will definitely be answered. Now look at this. This is the same supply demand curve. So in a section 1, this is what you do, right? Buy a call at or below the demand zone with 90 days out and minimum of 0.25 deltas. Is that correct? So because when the stock now hits the demand zone, the volatility is in section 2 and not in section 1. Because it is in section 2, we have some risks. Yes? Now to mitigate that risk, at or above your supply or your target, sell a call option. Alright, now you understood the strike selection and all. So buy and add the money or in the money call option, which is your anchor, and at the same time sell an out of the money call option, which is your offset. Strike selection, the anchor strike selection is at or below the distal line of the demand zone being used for entry, and offset is at or above the distal line of the supply zone being used as target. So this will create a spread strategy, which is called as a bull call spread. Again, close if target or stop is met. Rollover if expiry is less than 60 days. That is again 90 days, 30 days have passed, your stock is still moving in your favor. Roll it over. Both the units have to be rolled over, remember. And both the units will have the same expiry. So if you choose May expiry for anchor, the offset will also have May expiry. Evolve if implied wallet. Yes, this is again for 90 days out. Evolve if implied volatility moves to a different volatility section. Yes, so again section 1 and section 2 is primarily only in Nifty and Bank Nifty. Now here I will, now OTS says you can evolve, but I will tell you no need to evolve if the volatility moves to section 3. Because if it moves to section 3, most of the times you would see that the stock would have given you your gains. So you exit in section 3 rather than evolve, or tightly trail your stop loss. Are the maintenance rules clear? Exit both, yes. Simple, right? So if you know this, section 1, section 2 is just you have to add this. Now do you know what is evolution? When you entered in the demand zone in section 1, you just bought a call option. During the life of the trade, volatility moved to section 2, just go and add a offset unit. That is what is evolution. Because of the change in the implied volatility condition, you are adapting your options trade to mitigate the new risks that are coming into play for your trade. Make sense? Yeah, this needs practice. Everything needs practice. Practice only makes a man perfect. क्या लगता है विराट कोहली ऐसे ही बैट्समैन बन गया क्या? No, Amit. Yes, you do this when IV is in section 2. Let's take the same example. No, sir, you will not. That is an out of the money option. You won't lose. Okay. So here if you see you bought 100 call option here in section 1, and in section if the implied volatility was in section 2 instead, along with this 100 call option you also sell a 135 call option. Is that clear? At or above supply. So here the line is drawn at 132.90 as the target supply line. We chose the strike above that point. Alright, Bhavesh? And the net Greeks are the sum of the individual Greeks. So this is the anchor, the first one which you have bought. This is the offset which you have sold. The anchor has a delta of 0.6856. The offset has a delta of 0.2189. 0.6856 minus 0.2189. Why minus? Because you have sold it, remember. You have sold it. So 0.6856 minus 0.2189, delta is 0.47. Is it greater than the delta that we wanted, which is 0.25? Perfect. Now if you look at Vega was nearly 19.19. Now and for the anchor unit and for the offset unit the Vega is 0.15. So after adding the offset unit, look at how we have tamed Vega from 0.19 to 0.03. So if volatility drops now, you are not going to lose much because of Vega. Earlier you would have lost 20 paise, now you would lose only 3 paise. And theta is also mitigated. Theta was initially 6 paise, has now dropped down to 2 paise. So both gets mitigated and our trade becomes safer. Understood everyone? Similarly, bear put spread is the opposite on the put side. Potential benefit from IV reverting to mean. IV is in section 2, scrip is in a downtrend and trading in a supply zone. The offset unit provides protection in case IV does not revert to the mean and keeps dropping. Risk limited again, reward limited, and break even is anchor minus strike because we are using puts to create a bearish position. Delta is negative because it's a bearish position. Theta is negative because uh, it's a debit strategy, and Vega is positive but mid is compromised here. So this is the net resulting Greek, and this is how the PNL graph looks like. So here you had bought a put option when you were trading in section 1, but since you're trading in section 2, you then go below your target demand zone and sell a put option. So buy an at the money or in the money put option anchor, and sell an out of the money put option offset. Parameters minimum 90 days out, and the net resulting Greeks are 0.25 delta minimum. Strike selection at or above the distal line of the supply being used for anchor, and for offset at or below the demand zone for the target that is being used. Close if stop or target is met based on script price. Rollover if expiry is less than 60 days, and you actually don't need to evolve these strategies. Yeah, both are same expiries. So whatever you're going to learn in this class is all going to be same expiry. Now this is our, yeah, this is the stock target, Renuka, not the anchor unit target. The stock trade. Yeah, and when you exit, so you exit your anchor and offset when it hits the target line on the underlying. So you remember this 1500 put option that we had bought in section 1 at this supply? Before the break, we took this example, right? So the same thing, but because it volatility is in section 2, you add the short put option at or below the demand zone target. And the net resulting Greeks are sum of both 0.487 and 0.911. Your delta is 0.39. Is it greater than 0.25? Theta from 11.5, you have compromised it to 6.5, and sorry, Vega, and theta is again compromised from 0.1433 to 0.04. So theta has reduced, but primarily we are concerned about Vega because as time passes, theta will keep on increasing. Now in both these cases, the change in theta and change in Vega are beneficial to us, right? As option buyer. That's it. Profit you'll come to know tomorrow. Yeah, that I'll teach you tomorrow, the difference in the strikes. Shrikant. Correct, Amit. Correct, 60 days or less. No, Deepa, that is for anchor. That rule is for anchor, that 60 days. This is the offset. So the offset will always follow what the anchor is doing. So if anchor has 90 days, offset will also be 90 days. If anchor is 60 days, offset will also be 60 days. Certain strategies in XLT which are called as diagonals and double diagonals, which use same expiry, same different expiry and different strikes. All right. So are these strategies clear to you? So we completed 6 strategies today: long call, long put, short call, short put, and bull call spread and bear put spread. So tomorrow morning we will cover the credit strategies and the two non-directional strategies in the morning, and after that we will start with our reward to risk calculation. Okay. So today it is important that you guys go and read all these 6 strategies that you have done. No, Arun. You can program a tool like that if you want. No problem, Renuka. So now make sure that all these 6 strategies you read, understand them thoroughly, because if you understand them, then tomorrow it will be very easy for us. Tomorrow is the last day, remember. Finally, last day. नहीं सर जी, मैं थक गया हूँ. मेरा ट्रेडिंग मिस हो रहा है इन सब चीजों में. I could have actually got into a lot of long trades. But just that when after I teach and I finish my gym in the evening, I don't have the energy. I go off to sleep. I have no ideas, Rashish. That is Rahul's strategy. You will have to ask Rahul. I don't use those strategies. All right. So are we good today? Is everything good? Yeah. So please go through these 6 strategies. No, BFF is in XLT person. It is not here. Yeah. So today there was today, and in fact yesterday also we could have gone long aggressively. All right. In stocks, not in index. Best friends forever. BFF, which is breakout for free. It's an XLT strategy. You can go through that in the XLT sessions. It's not covered in this. Let me check. Right. So monthly, it's coming up from a monthly area of demand. Okay, monthly supply is still far. I mean, at least it should have target till 550. It can go on based on the monthly. Based on the weekly, let's see. Yes, definitely that's a weekly area of supply. but probably might not hold because it is low in the curve. All right, so the next thing could be there. This is the original supply. Actually, that's not the supply. On the weekly, that's the original supply. On the daily, so look at this was the trade that I had taken some time back in Tata Steel. Look how beautifully it came down, but I got out here itself, but got a 6:1 on that. Yeah, could have got much more. So this is how I trade. Just patiently wait. So look at the amount of weight that I had. This is a daily chart, okay? When this happened, right? That's when I figured out that there is a trade at this supply zone. Look at the days 1, 2, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 28, nearly 1.5 months. Now the trend shifted when it fell down. But then like nearly 1.5 months placed an alert that the order was in. No, this was futures. Now BFF, all right, we have this gap. That's the danger. Okay, 506. Yeah, we still have some time. We'll look at it. I'll answer that tomorrow, Ashish. Okay, last half an hour I've kept for all how to start and what all you need to do. Let me stop the record. Then you are going to miss out on all the RR calculations.